You know what's fascinating? While everyone's been distracted by the latest market headlines, something extraordinary has been happening behind closed doors. Central banks around the world have been quietly accumulating gold at a pace we haven't seen in modern history. And I'm not talking about a few extra bars here and there. I'm talking about over 1,000 tons per year for 3 consecutive years. That's not a trend. That's a revolution. Let me paint you a picture of what's really going on. In 2022, central banks purchased 1,136 tons of gold. That was a record. Then in 2023, they did it again, over 1,000 tons. And in 2024, another 1,045 tons. 3 years in a row of unprecedented buying. Now, when the world's most powerful financial institutions all start moving in the same direction at the same time, you need to ask yourself, what do they know that we don't? Here's where it gets interesting. These aren't just any buyers. We're talking about the National Bank of Kazakhstan, the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey. These are the institutions that manage trillions in reserves. They have access to information and analysis that most of us will never see. They employ armies of economists and strategists whose entire job is to protect national wealth, and they're all reaching the same conclusion. Gold needs to be a bigger part of their reserves, much bigger. But why now? What changed? To understand that, you need to understand what happened in the global financial system over the past few years. Remember when Russia's foreign reserves got frozen after the Ukraine conflict started? That sent shockwaves through every central bank in the world. Suddenly, holding your reserves in dollars or euros didn't seem quite as safe as it used to. Because if geopolitical tensions could freeze Russia's reserves, whose reserves might be next? Think about it from their perspective. You're running a central bank. Your job is to protect your nation's wealth. For decades, you've been told that U.S. Treasury bonds are the safest asset in the world. The dollar is the global reserve currency. Everything's fine. Then overnight, you watch hundreds of billions of dollars in reserves become inaccessible. Not because of default, not because of bankruptcy, but because of politics. That changes everything. So what do? You diversify. And the oldest, most proven store of value in human history is gold. It can't be frozen, it can't be sanctioned, it can't be printed. It just sits there in your vault, maintaining its value regardless of what's happening in the geopolitical sphere. That's powerful. That's security. Now, let's talk about what this buying pressure actually means for the gold market. When central banks buy gold, they're not day trading. They're not looking to flip it next quarter for a quick profit. They're accumulating for the long term. This is structural demand, and it's happening at a scale that's fundamentally reshaping the market. Here's a number that should make you sit up and pay attention. Through October alone, central banks had already purchased 254 tons. That's not for the year. That's through October. And here's what makes this even more significant. This buying is happening while gold is at record highs. Usually when prices surge, buyers back off. They wait for a pullback. But central banks aren't waiting. They're buying at $2,600, $2,700, $2,800 per ounce. That tells you something about their long-term outlook. Goldman Sachs is now forecasting gold at $4,900 per ounce by the end of next year. Let that sink in. One of the most conservative institutions on Wall Street is predicting gold will nearly double from current levels. And their reasoning? Central bank demand. They're not basing this on speculation or technical charts. They're looking at the structural shift in how the world's reserve managers are thinking about gold. But there's another layer to this story that most people miss. It's not just about how much gold central banks are buying. It's about where they're buying it from. For decades, Western central banks were net sellers of gold. The Bank of England famously sold half of Britain's gold reserves at the bottom of the market. The Swiss National Bank sold 2,300 tons. They thought gold was a barbarous relic, a useless asset that didn't generate yield. Now, Western central banks have stopped selling, and Eastern central banks are buying aggressively. China, India, Turkey, Kazakhstan, Poland. These aren't random countries. These are nations that are actively working to reduce their dependence on the dollar-dominated financial system. They're building alternative payment systems. They're trading in local currencies, and they're backing it all with gold. The BRICS nations have been particularly aggressive. Brazil, Russia, India, China, South Africa. They've been talking for years about creating an alternative to the dollar system, And while the headlines focus on their currency discussions, the real action is in their gold purchases, because you can't create a credible alternative reserve system without hard assets backing it, and gold is the ultimate hard asset. Let me tell you a story that illustrates just how serious this shift is. A few years ago, Germany decided it wanted to repatriate its gold from the Federal Reserve in New York. This was gold that had been stored there since the Cold War. Germany asked for it back. And you know what happened? It took 7 years to get it all back. 7 years. For gold that was supposedly sitting in a vault ready to go. That raised a lot of questions. Questions that other central banks started asking themselves. Now, more and more central banks are choosing to store their gold domestically. They want physical possession. They want to know exactly where it is and have immediate access to it. That's a fundamental shift in trust, and it's driving demand not just for gold ownership, but for physical gold that's actually in your possession. Here's where this gets personal for you. Because this isn't just a story about central banks and geopolitics. This is about what happens to your wealth when the world's reserve managers are all moving in the same direction. When institutions that manage trillions decide that gold needs to be a bigger part of their portfolio, that creates a price floor. It creates sustained upward pressure, and it means that the old rules about gold being a volatile, speculative asset don't apply anymore. Investment demand for gold has climbed to over 1,560 tons. That's up 33% year over year, and this is happening across all categories. ETFs are seeing inflows. Retail investors are buying coins and bars. Institutional investors are allocating more to gold. Everyone's moving in the same direction. And when you combine that with central bank buying, you're looking at demand that's fundamentally outstripping supply. Let's talk about supply for a minute because this is crucial. Gold mining production has essentially plateaued. We're not discovering major new deposits like we used to. The easy gold has been found. What's left requires more capital, more time, and more resources to extract. Meanwhile, demand is surging. That's the classic setup for a sustained bull market. But here's what makes this different from previous gold rallies. In the past, gold would spike during crises and then fall back when things calmed down. It was a fear trade, a panic trade. This time, the buying is strategic and sustained. Central banks aren't panic buying. They're systematically reallocating their reserves. That's not going to reverse when the next crisis passes. This is the new normal. Now, I want to take a quick moment here because this is important. If you're sitting on retirement accounts worth $100,000 or more, you might want to pay attention to this next part. A lot of people don't realize you can actually hold physical gold inside a retirement account through what's called a gold IRA. It's a way to get the tax advantages of a retirement account while holding physical precious metals. I put together a free guide that explains exactly how this works, how to set it up, and what the rules are. It's in the description below. No obligation, just information. Worth checking out if you're thinking about how to protect your retirement savings in this environment. All right, back to what's happening in the market. Because there's another dimension to this story that's absolutely critical. The paper gold market versus the physical gold market. Most gold trading happens on paper. Futures contracts, ETFs, derivatives. These are claims on gold, not actual gold. And for years, the paper market has been much larger than the physical market. That's created a situation where the price of gold is determined more by paper trading than by actual supply and demand for physical metal. But something's changing. As central banks demand physical delivery, as more investors want to hold actual gold rather than paper claims, the physical market is starting to assert itself. And when physical demand exceeds available supply, that's when you see real price discovery. That's when the paper market has to adjust to reality. There's a term in the gold market called backwardation. It's when the spot price of gold is higher than the futures price. That's unusual. Normally, futures trade at a premium because of storage costs and time value. But when you see backwardation, it means there's a shortage of physical metal available now. People are willing to pay more for gold today than for a promise of gold in the future. That's a powerful signal. We've been seeing periodic backwardation in the gold market. It doesn't last long because arbitrageurs step in. But the fact that it's happening at all tells you something about the tightness in the physical market. And as central bank buying continues, as more investors demand physical delivery, that tightness is only going to increase. Let me give you some context on what this means historically. In 1971, when Nixon closed the gold window and ended dollar convertibility to gold, gold was $35 an ounce. Within a decade, it hit $850. That's a 24x increase. Now, I'm not saying we're going to see that kind of move again. But I am saying that When the fundamental structure of the monetary system shifts, gold responds. And we're in the middle of a structural shift right now. The difference is, in the 1970s, it was about inflation and currency debasement. Today, it's about geopolitical realignment and the fracturing of the dollar system. It's about central banks around the world deciding they need an alternative to dollar reserves, and that alternative is gold. That's potentially even more powerful than the 1970s dynamic because it's not just about protecting against inflation. It's about protecting against systemic risk in the entire global financial architecture. Think about what's happening with BRICS expansion. The group just added several new members. They're talking about a BRICS currency. They're building payment systems that bypass SWIFT. They're trading oil in yuan. Every one of these developments reduces the dominance of the dollar. And every one of them increases the importance of gold as a neutral reserve asset that no single country controls. Here's a question worth pondering. What happens when the dollar is no longer the undisputed global reserve currency? Not if, but when. Because that's the direction we're heading. It might take years or decades, but the trend is clear. And in a multipolar monetary system, gold becomes more important, not less. Because it's the one asset that every country trusts. It's the ultimate neutral reserve. Now, some people will tell you that gold doesn't generate yield. It just sits there. And that's true. But you know what else is true? It doesn't have counterparty risk. It can't default. It can't be inflated away. And in a world where trust in institutions is declining, where geopolitical tensions are rising, where the monetary system is being fundamentally restructured, those properties are incredibly valuable. Let's talk about what this means for the average investor. Because you don't need to be a central bank to benefit from this trend. In fact, individual investors have some advantages that central banks don't. You can move faster. You can be more nimble. You can make decisions based on your personal situation rather than political considerations. The key is understanding that this isn't about timing the market perfectly. It's about recognizing a structural shift and positioning yourself accordingly. When central banks are buying 1,000 tons a year, when Goldman Sachs is forecasting $4,900 gold, when investment demand is up 33%, you're not trying to catch a short-term trade. You're aligning yourself with a long-term trend. And here's what's beautiful about gold. It's liquid. You can buy it in any amount. You can sell it anywhere in the world. There's always a market. Compare that to real estate, which takes months to sell, or private equity, which locks up your capital for years. Gold gives you the security of a hard asset with the liquidity of a financial asset. That's a rare combination. But not all gold investments are created equal. There's physical gold, which you can hold in your hand. There are ETFs, which give you exposure to gold prices without the hassle of storage. There are mining stocks, which give you leveraged exposure to gold prices but come with company-specific risks. And there are gold IRAs, which let you hold physical gold in a tax-advantaged retirement account. Each has its place. Physical gold is great for wealth preservation and having something tangible. ETFs are convenient for trading and don't require storage. Mining stocks can outperform during bull markets but are more volatile. And gold IRAs combine the benefits of physical gold with retirement account tax advantages. The point is, you have options. And the right choice depends on your situation, your goals, and your risk tolerance. But what's not optional is understanding what's happening in the gold market right now. Because this is one of those moments where the fundamentals are so strong, where the trend is so clear that ignoring it could be a costly mistake. Let me share one more piece of the puzzle. The relationship between gold and real interest rates. Historically, gold performs best when real interest rates are negative. That means when inflation is higher than the interest rate you can earn on safe assets like treasury bonds. Because in that environment, holding cash or bonds means you're losing purchasing power. Gold, which maintains its value over time, becomes more attractive. Right now, even with interest rates higher than they've been in years, real rates are still relatively low when you account for actual inflation. And if central banks start cutting rates while inflation remains sticky, real rates could go negative again. That would be rocket fuel for gold prices. Combined with the structural demand from central banks, you'd be looking at a perfect storm of bullish factors. But here's what's really interesting. Gold has been performing well, even without negative real rates. It's been hitting record highs while interest rates are elevated. That tells you the central bank buying is so strong, the geopolitical factors are so compelling, that gold is breaking its traditional correlations. It's not just a hedge anymore. It's becoming a core strategic asset. Think about portfolio construction for a moment. The traditional 60-40 portfolio of stocks and bonds has been challenged in recent years. When both stocks and bonds fall together, as they did recently, that diversification doesn't work as well. Gold, on the other hand, tends to move independently of both stocks and bonds. It provides true diversification. And in a world of increasing uncertainty, that diversification is more valuable than ever. Financial advisors used to recommend 5% gold allocation. Now, some are suggesting 10% or even 15%, not because they're gold bugs or doomsday preppers, but because the math works, because the risk-adjusted returns improve, because when you run the simulations, portfolios with meaningful gold allocations perform better over time, especially during periods of market stress. And we're likely entering a period of increased market stress, not because of any single crisis, but because of the cumulative weight of multiple challenges: geopolitical tensions, monetary system restructuring, debt levels that are unsustainable, banking system vulnerabilities. Any one of these could trigger volatility. Together, they create an environment where having hard assets as part of your portfolio isn't just smart, it's essential. Here's something most people don't realize. The gold market is actually relatively small compared to other financial markets. The entire above-ground gold supply is worth around $13 trillion. That sounds like a lot, but it's less than the market cap of the US stock market. It's a fraction of the global bond market, which means if even a small percentage of global capital decides to allocate to gold, the price impact could be enormous. And that's exactly what's happening. Central banks are increasing their gold allocations. Institutional investors are adding gold to their portfolios. Retail investors are buying coins and bars. It's a broad-based move into gold across all investor categories, and the market isn't big enough to absorb that demand without significant price appreciation. Now, I want to address something important. Some people look at gold's price and think they've missed the move. It's at record highs. Surely it's too late to buy now. But that's not how structural bull markets work. In a structural bull market, what looks like a high price today becomes a low price tomorrow, because the fundamentals keep improving, because the demand keeps growing, because the supply can't keep up. Remember, Goldman Sachs is forecasting $4,900 from current levels around $2,700. That's still an 80% gain. And that's not some wild speculation. That's one of the most respected financial institutions in the world, known for conservative forecasts, saying gold could nearly double. When was the last time you saw that kind of upside potential in an asset class with gold's stability and liquidity? The key is understanding that we're in the early stages of this move, not the late stages. Central bank buying is accelerating, not slowing down. Geopolitical tensions are increasing, not decreasing. The monetary system is fragmenting, not consolidating. All of these trends support higher gold prices, and they're not going to reverse anytime soon. Let me paint you a picture of what the next few years could look like. As central banks continue buying, as more countries join BRICS and reduce dollar dependence, as the physical gold market tightens, we could see gold break through $3,000, then $4,000, then potentially $5,000 or higher. Not in a straight line. There will be pullbacks. There will be consolidation periods. But the overall trajectory is clear. And here's what makes this opportunity so compelling. You don't need to be right about the exact timing. You don't need to pick the perfect entry point. Because when you're aligning with a structural trend this powerful, the exact entry point matters less than being positioned for the move. Whether you buy at $2,600 or $2,800, if gold goes to $4,900, you're going to do well. The real risk isn't buying too early or too late. The real risk is not participating at all. It's watching this historic shift happen and being on the sidelines. It's looking back in a few years and realizing you understood what was happening but didn't act on it. That's the mistake you want to avoid. So what does this all mean for you? It means taking a serious look at your portfolio and asking yourself, am I positioned for the world that's coming or the world that used to be? Because the world that's coming has gold playing a much bigger role in the global financial system. And if you're not positioned for that, you're taking on more risk than you might realize. It means understanding that gold isn't just for doomsday preppers or conspiracy theorists. It's for anyone who's paying attention to what the world's smartest money is doing. And the world's smartest money, the central banks that manage trillions in reserves, are buying gold hand over fist. They're not doing that because they're worried about a short-term correction. They're doing it because they see the long-term trajectory of the monetary system, and they're positioning accordingly. The question is, Are you?